He is a lawyer, and he also prepares taxes. In his office, they prepare American taxes. Dan does American taxes. They also do German taxes, and Canadian, of course. And Dan prepares wills and trusts. He actually did a trust for me. So, as you can tell, he's a very accomplished man. He also played Santa Claus. He has a no. He has a poster on his
music.
He has a poster on his wall of him as Santa Claus out on the street with tax time.
I'm not gonna, stand up and give a long speech. She's given me some suggestions on some things she'd like me to speak about. Probably the much better thing is to let me know, and I can probably answer your questions on most things. I hope I have some sort of general idea of things. She also forgot to mention that person she has dealt with in the past is a registered financial planner. So we have a financial planner in the office. It's a 3-person tax preparation business I have, and one of the it's called XBlox taxes, and we don't rip off XBox, we rip off H&R Block. It's XBlox because we're all X-Block employees. I worked for 12 years for H&R Block, and both my partners spent 3, 4, 5. I was there for about 5 years at H&R Block, and do give them credit. They are wonderful at training you how to do things. While I was there, I trained to do all Canadian returns, U.S. returns, corporate returns, trust returns. Basically, I got experience and training in doing any tax return north of the Mexican border. So they're very good at that. Unfortunately, they paid me what would now be less than minimum wage. Most of the people you will find don't know what they're doing, even though I was a teacher actually at some time. I taught some of the more advanced courses. I taught the courses in decease and trust, things like that. But they are really poorly treat their clients and charge you about 3 to 4 times as much. Anybody going to H&R Block, I know of no reason to have your taxes done by H&R Block. There's no service that they offer that we don't do better at. So I've been doing taxes for now over 16 years. As I say, I have one partner who is from Germany, speaks fluent German, goes back to Germany 1 month, the month of August every year, because she has her own tax preparation business there for corporate. And she can actually e-file a German tax return from here in Canada. And a lot of the business she's doing these days is, there was a gentleman in Hamilton who did German tax returns for many, many years. Was about in his 90s and probably should have stopped doing them in about his 50s, because that's about when he last knew what he was doing. She once had a client come and show this stamp on a document that he had stamped it. And she said, "What the heck is that?" And she went back to Germany and asked the people at the tax authorities in Germany, and they said, "We haven't used that stamp since the 70s. My God, what is that thing still doing around here?" And every day, I think we've convinced him to drop him out. We're hearing rumors he's not doing taxes for anybody this year, so we hope all the German people will come down to her. She fluently German, speaks better German than she does English, or something to worry about. And then my partner, another partner, does the financial planning, and he can put you into particularly RDSPs and things like that, which Eileen has asked me about. And as I say, I do U.S. tax returns for Canadians, Americans who are here in Canada, and people who go down and work in the States, have investments in the States, things like that, homes in the States, snowbirds and things like that, who have to be careful of their tax situation. And I have a law practice. I would call it a solicitor's practice in that I don't go into court. I avoid things like family law because it's miserable. You cannot have an agreeable divorce. It's not humanly possible. So I do wills and trusts, real estate work, setting up corporations and things like that. Much of it is to complement my work doing taxes. So that's a little bit about me. Aline has asked me to speak on several matters that she has had experience with. Let me talk first about one of my favorite subjects, sort of. I'll explain that in a minute. The disability tax credit. It is one of the most underused but most valuable credits. You'd be surprised at how many people qualify for it and have never applied for it. Problem is, you just can't put it on a tax return. You have to have a form filled out by a doctor, nor actually this year it can be a what do they call them? Special nurses, physician nurses, assistants, something like that.
Nurse practitioner? Nurse
practitioners can now, as of this year, fill it out. Takes a doctor or a nurse practitioner 5 minutes. It's not like they have to give an essay. It's tick off a box. Do I feel that this person meets the qualifications for being disabled? And you can go back. So that it's specifically on it, you put when. The doctor has to say when it began, when he felt the disability began. And you can go back and put it on back tax returns. It can benefit you to the tune of up somewhere probably around $1,500 in taxes each year. I have seen, it is not unusual for somebody to get $15,000 for having to go back. One of the ones I've done several times in the past is somebody who has a child born with Down syndrome, and you don't find out that the child has Down syndrome until age 3, 4, 5, something like that. And but they were born with it, so you have to go back and adjust previous returns, and it could be a huge benefit. You either have it or you don't have it. So if you have it, if you have qualified for it, you get this big credit. It doesn't depend on your income. You can be a millionaire, make $1 million of income in the year, you can still claim it. It doesn't, no benefit. It's not one, there are some that click in only for low income people, but this isn't one of them. Once you have it, Revenue Canada does in some cases, depending on it and what the disability is, they ask every 3 or 4 years to go back to your doctor and get this form filled out and sent into them. Generally speaking, if it's some types of disability, they don't ever come after you again. They know certain things that don't go away. What I have a real problem with, I will tell you, is that if you Google disability tax credit, you will instantly get a huge page after page of ads for companies that will help you apply for it. What they do is they take 30% of whatever you get. So they say, we won't don't have to put anything up front, we'll help you out. We'll just take 30% of whatever you can get. Problem with that is, why they make so much money is, as best I can tell, their costs are about, well, let me see. They print off the form for you, costs 2 or 3 cents in paper and another 5 cents in black ink. That's good, but of course you can access the exact same form on Revenue Canada's website. Even at H&R Block, we used to print them off, and you walk into the office, say you need one, and it takes a couple of seconds to print the thing off and give it to you. You have to take it to your own doctor, so it's not like they help you out there. Once it's signed, I guess I don't know whether they send you an envelope and say put it in this envelope and send it off. Maybe they give you a free stamp or something like that. It gets sent off. Revenue Canada approves it or disapproves it. It's entirely a medical decision. It's very detailed in this case what qualifies as a disability. They approve it. They send you this letter saying you qualify to claim the disability tax credit on your 2013, 14, 15, 16, and going forward until we ask for it. They will probably, I guess, do an adjustment to help you. I assume they would at least go that far. It would probably take them another buck or two. And it goes back to Revenue Canada, and Revenue Canada sends you $15,000, and they take $5,000 of that. I'll do it for free. It bothers me, and there are things that really, really bother me. I mean, like there's one that takes out a 2-page ad in Maclean's magazine. Can you imagine what 2 pages of advertising costs in Maclean's magazine? And they make a huge amount of money on that. I can imagine, because as I say, they don't do anything. On the other hand, there is one I think is in Toronto, which does have a little variation in that they have a doctor who will help, firstly, help your doctor understand why a cut on your finger is a permanent disability. Acne is a permanent disability. Your life is ruined because your child has acne, so you should be able to claim the disability tax credit. Oh, and by the way, if you can't convince your doctor, he'll see them and he'll sign a document saying that you have a disability and send it off. This is why last year Revenue Canada tried to clamp down on it. They've more frequently in the last year been calling doctors just to confirm. As I say, it's a medical decision. As far as I know, what they used to do is they used to just accept it and confirm that the person was, signing it was a real doctor. But they tried to clamp down on it, on the abuse of it, and of course they got caught some very legitimate people who were trying to claim it, and so they've been forced to back off because of all the bad publicity, and these companies continue to thrive. And we see people come into our office all the time saying, I want you to do my this year's return because I just got it last year, and then the place charged me $3,000 of what I was supposed to get back for doing this. And yet they don't do anything. That's why none of them have offices. You won't drive down the street and see a company that says, we apply for disability tax credits. Do it on the web. You can do it nationally and just email you the stuff to print off yourself to take to your own doctor. So it bugs the heck out of me and has for a long time, and unfortunately I wrote my member of parliament and he didn't even answer me about it. I think there should be some way to get rid of them. But the disability tax credit is big if you can get it, if it applies to you. Even if sometimes we even send it in saying maybe it's a little iffy. I could tell you, for example, some things. Adult diabetes does not apply. Child diabetes does. If you have a child with diabetes, the child is eligible for it. They've accepted that. A few years back they changed it so maybe it's not just one thing that you have a problem with. Maybe it's several things that cumulatively. It's not a matter of I can't work, or if you can continue to work, you can still be disabled and continue to work. It is detailed, but there are a lot of things in there that basically they say the criteria is if it affects the way you your daily living. Some of it, I know of one case where they said there was a woman who could not get around without a walker. And their response was, okay, get her a walker. She doesn't qualify if she has a walker, But if she didn't have a walker, she would qualify for it. And so said, get her a walker, and she doesn't qualify for it. That was a real extreme case that they did about 8-9 years ago. So, but I would always encourage you think about it. I've had people come in and say, yeah, my husband had a stroke 10 years ago. If you've had a stroke, chances are a stroke, a heart attack, something like this, unless you're 100% fully recovered, you qualify for it. It can be short term. It has to be long term in the sense of more than a year. It can't be a broken arm or something like that. But you can get better from it. I mean, it's something, they will suspend it, saying, okay, it affected my life and I was disabled from 2000 to 2005, but the doctor says as I get older it's going to come back, and and so in 2015 the doctor fills it out and says, was okay for that 10 years there, now it's gotten worse and now it's back and disabled. They'll accept that type of thing. Generally speaking, as you get old, I know I could add I got sciatica and various other aches and pains myself here. I'm well on my way. I might not qualify for day, but one of these days I am going to send it. I'm going to think about it. You'd be surprised maybe if you did turn it down and if they don't accept it for whatever reason. Nothing lost as long as you don't go through one of these things online. Things do get worse, so if you lose the first time, you try again in a couple of years, then it is big. It is a major thing, and if the government's going to give you a reason to save a whole lot in taxes, thousands of dollars, save a whole lot of the taxes as far as I'm concerned. They don't give you a whole lot, they take a whole lot over the years, so get some back when you can. That's the disability tax credit. Okay. By the way, it can be transferred around. It can be transferred to a spouse. You could obviously, if your child qualifies for it, the parents can claim it. It can be transferred from several types of dependents. It can be transferred if you care for a parent or somebody who qualifies for it. It can be transferred to you. Maybe they're not old enough and they qualify for it but don't have enough income or something that they need the credit and you support them. It can be transferred to someone else, a child, and certain limitations on that, but that's fine. That's the way it works. So the disability tax credit is big. Lots of people don't know that they qualify, and Revenue Canada says it's the biggest one that people do miss. Anyway, I also wanted to speak about things like RDSPs. They are registered disability savings plans. Only been around for, they've been around a while, I guess, maybe 10, 12 years, something like that. They're not like RRSPs where you put money in and you get a deduction on your tax return. They're not entirely like tax-free savings accounts. They're close to what we call our ESPs, Registered Education Savings Plans, where you put money into it and the government also puts money into it. With our DSPs, so if you have a disabled, generally speaking, it's a parent who wants to take care of a child who has a disability. The RDSP, the benefit of it is, let's say you just want to put money aside into a mutual fund, that's fine, and someday the child inherits the money and after you pass away and that supports them. The benefit of our RDSP is the government chips in a whole lot of money. Up to the maximum, depending on your income, under about $90,000, you can, if you put $1,500 into an RDSP in a year, the government will chip in another $3,500. So in 1 year, you can have $5,000 in an RDSP, and only $1,500 of it is your money, the government. Eventually, when the child gets the money, it comes out. They only have to pay tax on the portion, the $3,500 that the government has chipped in, because you pay taxes on the $1,500 you chipped in. They have to be set up. Most banks offer them nowadays. Insurance companies, mutual funds, just like RSPs, you set them up in advance. The government knows that they're there and chips in that extra cash. So they're still growing, in a sense. As I say, they were completely unknown for a while. Now people know them more every year, but still not entirely used by as many people as probably should be using them. She also wanted me to speak about renovations. I just realized it was 2009 when we were in that recession, and the government came up with their idea of the general home renovation tax credit. That was that 1 year on your 2009 tax return. You could claim up to a $10,000 credit for work you had done on your home. The purpose of that was basically twofold: to get home renovators some business, because things were so bad, you remember, in 2008, 2009, there's a recession there. So get a whole lot of people renovating their home, give them some credit, and it pushed it for that 1 year. You wouldn't want to do it for a whole lot of years, because people would just eventually take advantage of it, and it wouldn't increase the amount of work being done for home renovating. So they only had it for the 1 year, have never brought it back. Another reason they did it was because there's so much in the underground economy, roofers who will, work on Saturdays and not charge you taxes because they're doing it off the books and things, but you needed to have that done on the books. So that one's gone and unlikely to be coming back. But there are benefits available for medical reasons to fix up your home. It's a little odd in that the province brought one in called the Home Accessibility Tax Credit a few years, 3 or 4 years ago. Then last year the federal government decided that they would have one, basically very similar, and the province decided they were getting rid of theirs. So 2016 was the last year you got an Ontario credit for basically renovating your home with things that would make it more accessible, more livable for medical reasons. For example, grab bars, ramps, widening doors, things like that. Different staircases and things like that. The two programs match, but the province decided last year they would get out of it, so it's not going to be on this year's tax return, but the Fed has decided they would get into it, so it's a federal credit on this year's tax return for doing basically exactly the same thing, fixing up your home to make it more accessible to a person who is disabled or a senior. Automatically at 65, they treat you the same way. So, yes.
You just answered my question. I was going to say, do we have to be already disabled
No.
if you're seniors?
No.
Okay.
They, no offense, it's not me that's doing this. They, in many cases, consider it the same thing.
Okay. Thank you.
At 65, they're willing to give you the same credits they're willing to give somebody who's disabled.
Forms available on the internet?
Is there a part?
Forms?
To claim it, it's a separate schedule. Yes, on this year's tax return, I think it's 12, Schedule 12 on the internet to put in how much you've paid I assume it's like the home renovation code. You have to put in your GST number, the company that did the work for you, and basic description of what it is. Yeah. It might even come, well, they're not sending out the package this year. The way they're working it this year is to save paper. If you did your tax return on paper last year, they will send you a paper return this year next week. Next week or the 26th?
You just got one.
Just got one?
Yeah.
If you did it electronically, they're not sending them out. And again, they say there will be a small, limited number of paper returns available at Canada Post outlets. So ordinarily, you used to be able to go and grab one from a big box there at Canada Post. Don't bet on it. And they're not there yet, and they specifically say they won't be there until next week. For example, you probably didn't know, you can't electronically file a tax return today. You haven't been able to for yet. They begin allowing you to electronically file a tax return 8:30 the 26th, on the morning of the 26th. We have done tax returns to people in mass. I've done them. They've been paid for and ready to go, everything's signed. And at 8:30 on the 26th, I will hit the button to electronically file them, and they will begin processing them now. Then, so nobody's getting a refund from Revenue Canada until 3-4 days at least after that. There's no use filing a return before the 26th. We're very slow because of that. XBlox is advertising, hey, you can't get your refund from Revenue Canada, but we're giving you using their discounting thing. But they will, there's no possible way, even those boxes, you see TurboTax or them that you see all over the place, big displays of them. In the very fine print on the inside cover of the box, you will find them saying, firstly, the program isn't certified by Revenue Canada until sometime in the month of January or February, and it has been certified that it works. And then it says they're not processing returns until the 26th. So if you're anybody who's bought one of those programs, they can prepare their tax return, but you can't actually file it through those TurboTax programs or an online program until the stroke of 8:30 on the morning of the Monday, the 26th. We used to go in on Family Day, because it's not a federal holiday. We used to be able to do it on Family Day as the latest. Generally, it's around the 15th. This is 11 days later, making a very, very short tax season. You got to get things together and get things done before April 30th. I don't know what Revenue Canada does. They do some odd things. We thought they were going to allow you to do more back years electronically, and they don't. And Revenue Canada is a world unto themselves in dealing with them. Our rule always is, if you call them up and you don't like the answer you get, call back 5 minutes later. You'll get somebody else. The person on the phone can be in St. John's, Newfoundland, or in Burnaby, British Columbia. Most of them, they actually have several systems. There are actually 6 different programs that Revenue Canada has for electronically filing tax returns. The people on the phone admit they are of 2 categories. Some of them have Revenue Canada Lite, and some of them have Revenue Canada. And if you get a person who has Revenue Canada Lite, they can't even give you information about your RRSP, what you do. They will transfer you to somebody who has the full program. They crash teach their people in January of each year. I have been on the phone when I could hear the person ruffling through the pages of his binder to try and get the answer. There were studies last year, and I have some material here that you read about it, where, you know, the answers they give are wrong a high percentage of the time. Unfortunately, they only have one basic number. We use exactly the same number, unfortunately. They're exploring a special number for certified public accountants. But frankly, if we have to call Revenue Canada, any tax preparer, we use the 1-800-959-8281, which is the same one we did. I don't know what the situation is here, but in Hamilton, years ago, you used to be able to go into the Hamilton office in downtown Hamilton, and you used to be able to pick up copies of all the stuff that you needed. There were actual people you could make an arrangement to speak to. Then they decided to get rid of all the forms and speaking to somebody, so they set up a bank of telephones where basically the phones only called one number, which was the general number. Then they decided to get rid of that. And so at one point in time, it was just a place where you could pay your taxes. Then they got rid of that. They still have an office in Hamilton, but it doesn't have a front door that you can go in anymore. Yes?
Do they record all the conversations so that you're giving bad advice there's on record?
Yes. When you speak with Revenue Canada, their instructions are the first thing they have to do is identify themselves and give you their employee number and state that this conversation might be recorded for quality customer service. And so if they don't give you their employee number, we had a case where they called us and the woman refused to said, you know, I'm not giving you my employee number. I said, well, I'm not speaking to you. And we called them back, and apparently this person's superior said, you know, she was legit, but she should have given you her employee number. They're required. At one point in time, we used to quickly scribble it down because, as I say, you'll never get that person again. It's not like you can, you know, call them back and you'll speak with them again, even if it's not possible. As I say, their call centers are all over Canada, and you'll never get the same person twice on the phone. So it's impossible if you're trying to pursue something. You're going to have to tell the same story time after time after time. Sometimes if you spend a half hour, 45 minutes, they will make a note on the file or something like that. They're supposed to note that we had a conversation about things, so it might show up there, but they're terrible to work with. And there's only one organization I know that's worse to work with, and that's the IRS. They're even worse. The point is, they can get away with it. There's nothing that you can do about, you know, having problems with them. And they're in the right, you're in the wrong, and it's your duty to prove that they've done something wrong. So if they state that this is the way it is, you owe this money. We were just talking earlier that Revenue Canada's policy is if you owe them money, they cannot forgive you that money. So if they say you owe us $20,000 plus penalty plus interest, you're going to end up owing them $20,000, and you might be able to go through several processes, and they will either reduce or eliminate the interest and penalties. Their opinion is that taxes are taxes. Everybody has to owe taxes, and they cannot forgive anybody. One of the good things about dealing with the IRS is the opposite. They will say, you owe us $20,000, okay, pay us $5,000 within the next couple of weeks, and we'll write off the rest. The IRS does that. Our whole companies, they advertise late at night. That's what they do. They can make arrangements with the IRS to write off part of your taxes. It doesn't work in Canada. They say, if we were to forgive one person, some of their taxes, everybody else would have to pay more. So we can't, that's not fair. So they'll give penalties and interest, but not the amount in taxes if they're satisfied. And then you can spend years fighting over whether you owe that amount in taxes. Those were the areas I mean, particularly about things like disability. There aren't major changes on this year's taxes. The big one I think we're expecting people to come in and freak a little bit about is people who have children and they're paying for their education, and the children get tuition and education credits and the parents get them transferred. I've had clients come in who have said, the tuition and education credits for my child, yeah, I pay for their schooling and that sort of thing. But it's theirs. They carry forward indefinitely. So let the child have them, and when they get out of school and making some money, they can use them since they don't normally need them. I've had clients come in and say, I'm footing the bills. They're living under my roof and eating my food. They got tuition education credits. They go on my tax return. So I literally, it's sometimes, the kids come in. There was one particular family where, I was reticent to say, but I had to say to the children, you are freely of your own business. It's your signature that's going on this agreeing to transfer to your parents. And, I said, they admitted Dad would kill them if she didn't sign it. But she was okay signing her credits over to her father, and her father said, I'm paying for them. Problem is that, the federal government has decided that they won't give you credits. They will only give you credits for your tuition, not the education credits that you've been getting in the past, and textbook credits. On the other hand, the province has done the opposite, and because the province now gives income-based free tuition to kids. If your kids are going to university and you're under certain income levels, they at least subsidize or pay for the tuition to an Ontario university. So the province is no longer giving credits for the tuition. Still has to be on the slips, but again, just like with the province is going a different way than the federal government is going. It's only Ontario and Saskatchewan that are doing it, and this is a transition year where you can still claim in the province of Ontario your tuition paid for the first 8 months of the year. So if your kid was going to Waterloo, Wilfrid Laurier in September to December of last year, whatever they paid in tuition, do not care provincially. Can't be claimed on the tax return anymore.
Making the assumption that family money is family money, right? In other words, they're all supposed to be on the same side. Would it not make more sense to transfer the money, the tuition credit to the person with the higher income? And the idea being that it's going into the family pot anyway. I mean, never mind. I mean the family resources.
Two things. One, the credit is a set amount. You're interested? I got a fair warning. I can talk taxes,
Well, in other words, it's not,
for a couple of days. But I'll tell you, there's two things that people don't understand. There's a difference. There's a deduction from income,
yeah.
and a deduction varies depending on what tax bracket you're in, and credits.
Oh, okay.
Credits are the same federally, 15%. If you pay $1,000 in tuition, it'll save you $150 in federal taxes. It's 15%. So it can go to either. It doesn't matter if the husband makes $100,000, the wife makes $50,000. It's going to benefit the family. They're both exactly the same. The other thing is tuition and these education credits, that people have been communicating. They technically belong to the child, who does not need them when he doesn't have any income, can make up to $10,000 like we all can while in school, and should have some left over. They can then carry forward And in this case, tuition education credits carry forward indefinitely for the rest of their lives. Whenever they make money which is sufficient to be taxable, they will be applied. Revenue Canada will even get it on file, and it has to be applied as soon as possible. So it's not like they're ever going to be lost. So again, you can decide whether what has been happening is kid spends 5-6 years in school, first year out, suddenly goes from an income of a summer job of $5,000, $10,000, suddenly has a job that pays them $50,000 a year. All those accumulated credits can be applied, and that first year they get a big refund check. $5,000-$6,000 is not unreasonable, quite common for somebody in a nursing or a professional program to have paid that much in taxes and spent that long in school. And at just the time when your kid needs $5,000 or $6,000, because the first thing he's also probably got is a big loan, which he has to pay back, which would be helpful. But their first year out, many parents look at it that way. They get applied somewhere. And again, if you consider, every family is different. Varies. So as I say, we expect a lot of clients to come in this year and say, I always get a big refund because I got these tuition transfers from my kids. Ain't gonna happen this year. Future years are gonna be even less.
That'd be obnoxious and ask another question. I'm at the stage of life where now I've got RIFs, retired income, whatever they are.
Mm-hmm.
Now I've got to pay the piper on all those RSPs, I suppose, stashed away. A couple of pieces of information I got that seem to be conflicting. And one is that if I have a chunk of money in my RIFs and I die, that the government will take a big chunk of that.
You bet.
Okay, so the other story I got from that was, oh no, it's only to the second, so my wife wouldn't be paying it, but my daughter would. So, could you clarify that, please?
RIFs and RRSPs are not a way of, you don't eliminate taxes, it's just deferred. When you're working and you're in a higher tax bracket, put money into an RSP, and then when you take it out, when it comes out after you've retired and you're at a lower tax bracket, you pay less in taxes. That's what RSPs and our RIFs are about. With a RIF or an RSP, whether it's matured or not, the RSP is matured or not, the amount you have, let's say you have $100,000 after a lifetime of putting money into an RSP. Or a RIF, let's say it's in a RIF. And you have $100,000 in there, and you pass away. It can be rolled over without going over the limit or anything to your spouse. And we always do that. And they will have a RIF with $100,000 in it. Problem is, if you don't have a spouse or your spouse has predeceased you, in those cases, that $100,000 is deemed to have been paid out to you 1 second before you passed away. And it all gets added to your income. So you suddenly go from your retirement, which makes you have a company pension, CPP, old age security, some investments, maybe $50,000 a year. You're in that, let's say 45. So you're still paying the 15% tax bracket. Add 100 to that, and you're now in the $150,000 worth of income on your final return, and you're paying 29% tax bracket. And a big chunk of it is not going to your descendants, your beneficiaries. It's going to pay that taxes. So there are various ways of getting around that. One, give your beneficiaries the money before you die. Take it out pay the taxes on your lower income, maybe do it over a few years, so you're not taking the whole 100,000. Whenever you take that 100,000 out, it's added to your income. So maybe take 10,000 out of it now and say, kids, you're going to get it when I die in a few years. Or there are ways you can set up trusts and make them the beneficiaries of the trusts and avoid that type of situation. Take it out and party yourself.
There it is.
Well, I mean, I'm sorry, I have this argument where, how about, I'm just not into living my life to leave everything for my children. My children are good. The children would be fine. They'll be well taken care of through their lives, and you make sure they get a good job and they're off on their own and they're not literally impoverished. They don't need an extra 100,000, and you might enjoy a around the world cruise. So spend it on yourself. What do they need?
Well, you have a father who's an actor. And his backup plan is to be a writer.
But yes, you've hit the dangers of RIFs and RRSPs. If you don't have a spouse that can be rolled into theirs, then it comes out automatically there. And I've had families sitting in front of me being told, okay, the tax bill on Dad's final tax return is $55,000. Oh, right. You only had, there goes most of the money that was in that RIF. A big part of his estate has suddenly gone.
Can I ask you about this? This apparently is a fairly new thing about the principal residence. And when you don't live in the principal residence, but another family member does, they didn't used to have to pay taxes on it, something like that?
You can only have one principal residence own it at any given time. You can, there are ways where you can change which residence you designate. For example, one of the big problems people have is people who own cottages are now passing away. They bought a cottage, in the family cottage, in the 50s and the 60s for a few $1,000s up in Muskoka, and now suddenly it's on a lake and it's now worth $500,000, and it's not a principal residence. So when you pass away, the estate has to pay the capital gains tax on that before the kids can inherit. The example I always use, people think it's crazy. Just the American example of what is it? I think it was a rich family owned the Buffalo Bills, and he had paid less than $1 million for the Buffalo Bills franchise in the early 60s there, and when he passed away a couple of years ago, it was an NFL franchise was worth $600-700 million. There was capital gains tax to be paid on that, and the family didn't have that much income to pay all the taxes. So they had no choice. They had to sell the Buffalo Bills right away after he passed away. And the Buffalo Bills had a new owner for the past couple of years. Same thing, is your family going to have enough money to pay all the taxes or capital gains on that property, which is now worth so much? Do they have it as income? They may have to sell the family cottage, which most people want to keep in the family. It's been, where you've raised your kids for 30 years, everybody's gone up there every couple of weekends, something like that. But do you have the money to pay the taxes on it without having, being forced to sell it off now? And that's, as I say, many things, if you can't roll it over, like you can with a RIF or an RSP to your spouse, and that's basically the limit. There's also things for, a child who is again disabled. But otherwise, the taxes get paid on that final return, and it eats up a big part of your estate there.
I can keep coming up from left field here. Again, somebody has said to me that you should have a separate will for your real estate, separate will for your principal residence, etc. Is that, what's the thinking, and is it necessary, does it make sense?
I've heard about it. I don't think so.
I think, no, it was a lawyer that told me that, so I'm afraid I will.
Everybody has their own opinions. In taxes, 90% of them are wrong. I wouldn't disagree with another lawyer. Well, yeah, I would. Other lawyers. Maybe a more detailed look at your situation. He might have thought that it would be good, but ordinarily, one will do. Maybe you want to limit probate fees and things like that, which also have to be taken into account when you're doing a state. The province of Ontario gets their percentage based on how much falls into probate. So there's more of the estate that is going towards paying the government rather than paying, people who want to get the money.
I heard that if you want to avoid probate fees, you should leave your estate to your children, naming your children, rather than just an estate. True?
No. If you're talking about, putting it in a will, no. But if you hold things jointly, they don't fall into the estate. So, for myself, I know when my mother passed away, before she had passed away, the house was transferred into myself and my mother's name. So when she passed away, it was held jointly, and because it didn't fall into the estate, and I took it entirely. Bank accounts, again, it's a balancing act. Do you want to have, for many cases, people want to have, say, a child on a bank account as it jointly held, and what the money in there won't pass into the estate, it automatically goes to the survivor. The problem, of course, with that is a joint bank account, they do have access to funds while you're still alive. And I say to people, just understand, I'm sure you love this person, you trust this person, and that's fine by me if you want to do it, but do understand, I know of cases where some things change. And it's not like you can just bounce out, say, no, I don't want them joint because they're going to take my money. We all know, you read stories about people who, elderly people who don't, have had money and they're getting ripped off by their own children for using the money. And whether it's not your child, maybe it's your child, maybe it's, their spouse or something that says, she really doesn't need that big a house, get her out there, put her in a home, this sort of thing. We can use the money to go on vacation, you have access to it. These things happen. It's your choice, whether you put it in joint, but if it's not jointly held, it goes into the estate. So,
What are probate fees? How much are they?
they're not large. They're 1% or something like that, but they're not nothing. On a large estate, they can be, something. No, not 1%, maybe 2 or 3%, something like that. But you want to avoid everything.
Is there capital gains tax on a principal residence?
No. That's why you name one. Like I said about just also with cottages, you can, had you known that your house in the city, which you bought for $100,000, was now going to be worth $500,000, and the cottage in Muskoka, which you bought for $100,000, is now worth $1 million. You could have decided to designate the cottage as your principal residence, because you live there at least part of the year, and then pay capital gains tax on the house in the city because it's only gone up $400,000 over the years, whereas the other one's gone up $900,000. That's hindsight. You could carefully watch the current market things have gone so, and then what would happen if you had the current market where things here in southern Ontario, Hamilton, have gone up so much, and they're getting close to what the cottage probably has gone up in value, if not exceeded it. So you can only have one place as your permanent residence, but you can and move it around. If you were to move into an apartment, you can sell off the house, no capital gains because it's been your permanent residence until now, and designate the cottage as your permanent residence for future. When you sell it, would be capital gains tax to be paid then on what it's earned from since you first bought it, but only until this date. Anything that goes up, once it's named as a permanent residence, the principal residence, it doesn't attract capital gains tax as long as that is.
I have a trailer that I own on land that I rent. That doesn't count as a cottage, does it?
The trailer has a value.
Yeah, but it's like a big vehicle, isn't it?
No,
Huh?
even vehicles. If for most people your average car declines in value, but if for some reason your vehicle increases in value, if you bought a Studebaker in the 60s and it was for a couple of $1,000s and it's now worth $30,000-$40,000, you pay capital gains tax on that. And
Yeah.
anything that goes up in value incurs capital gains
Trailers
tax.
usually depreciate.
They go down.
Generally.
Yeah.
Yeah.
Yes, and because it's not the land, so yeah. Often what we have, there are professionals or real estate people who will tell you, compare the bill you paid for it when you bought it with what you could sell it for today. And yeah, in most cases it's gone down in value if you're living in it, yeah.
Is the capital gains usually on what it sells for? Is it ever based on market value?
If it's based, it has to be reasonable. And Revenue Canada generally won't step in unless it's really, really unreasonable.
So
So if you sell it to your kid for $1,
Yeah.
no, they're going to say market value.
Right.
But if you sell it to your kid for, $20,000, and most people would say it's probably worth closer to $50,000 or $100,000, they'll say, bad deal. They won't step in unless it's really, really unreasonable. They'll accept the selling price. It also helps. Another factor they do take into account is whether it's a hands-off transaction, so selling it to a child for a very low amount is very different from selling it independently for a very low amount. Again, they would be a little suspicious, but if it's reasonable, they would say even selling it to somebody close to you is just giving somebody close to you a good bargain.
Prior to my mother passing away, when we sold her house, I calculated the estate, and let's just say it was around $400,000. I basically calculated what all the siblings were going to get according to her will, and I started distributing the cash before she died, so that when she died, we only had about $50,000 left in the estate. So 2 questions. Was that a good idea because it lowered the amount of the estate when I had to do her final tax returns? And B, do the siblings have to show that money as income and pay tax on it?
Okay, you said this happened before she died.
Yeah, really when we sold the house.
So before you die, the will is nothing. It's a piece of paper.
Oh.
Means nothing. You have to have power of attorney to do anything. And a power of attorney only works until the day you die.
Yeah.
So to buy and sell, deal with your mother's stuff before she died, you needed a power of attorney. The minute she passed away, trash the power of attorney because it doesn't help anymore.
Yep.
The will takes over, and it's the person who's named as the executor in it. Okay? So if you decided you had power of attorney before she passed away, and using that power of attorney, you gave things, you could do anything. But you decided you'd start giving shares to the other beneficiaries there.
Mm-hmm.
that reduces. That's giving gifts before you pass away to ensure the state is down. Yeah, that works. That
So
works.
it's-
And it's not taxable.
It's
In
not.
Canada, gifts are not taxable at all. It's one of the things I had to deal with in Canada versus the United States. Certain things in Canada are considered non-taxable because they're not earned by income. The big one being lottery winnings. In Canada, they're not taxable. They are in the States. So if you know anybody who is an American and plays the Canadian lottery, they need to give the money to their spouse or somebody else who's Canadian, because Americans have to do tax returns in the States even if they live in Canada. And if they win even an Ontario lottery, they have to report they won $1 million in Lotto 649 on a U.S. tax return, and the U.S. will take 45 to 50% of it. So that's why, and as I always say, when you hear these numbers thrown around on the, Powerball, you've won
Yeah, 100 million.
100 grand or something, $100 million. No, if you take it as a lump sum, the IRS gets the first 50. And it doesn't even come to you. The lottery company sends it straight to the IRS. You don't get a check for $100 million. And if you're, I have clients who freely know they're Americans, they're married Canadians, and they live here in Canada, but they still have to do a U.S. tax return. And I've told them, don't play the lottery. Your husband should play the lottery and put it in his name. He wins it. He doesn't have to do a U.S. return, and in Canada you get it tax-free. Gifts, they're considered things like gifts. And gifts, again, there's a limit on even gifting in the United States. There is a gift tax. In Canada, if you give somebody, $50,000 as a gift, it's not income, so they don't report it as income. Taxes were paid on it when your mother earned that money. So it's already been paid. Taxes have been paid on it. What was the second?
So if there was 50,000 left in the estate at the time of death, what kind of money of that is going to go to Rev Canada? How much of that are they going to take?
In the estate, after taxes have been paid on the final return, or
No, I'm wondering what the taxes would be on the final return.
the taxes on the final return will depend on what the $50,000 is. If it's in
I
an
think there was
RSP,
RSPs,
which you add the amount of them 1 second
and a
on the
couple
final
bank
return.
accounts, a few $1,000s.
The amount in the bank accounts do not. The money was put in there and no deduction was claimed when you can't claim a deduction when you put in a bank account like you can with an RSP. They just go into the estate. So on the final return, you would have the interest earned, say, on the bank accounts until the date she passed away.
Which is next to nothing over the last couple
Probably,
of years.
probably.
1% or...
And then the amount that was in the RSP or the RIF. Then the estate, it takes over when you do a trust the day after, which begins the day after she passed away, and anything they earned from there on in, perhaps still nothing on the bank accounts, you don't pay any income taxes on. You would pay, the trust would pay income taxes on whatever what was left in the RSP would still earn money. And you would pay taxes on what it earns. And then as far as probate fees go, it's the capital. So it includes what goes into the estate would be $50,000 in an RSP plus the amount into the bank accounts, and you take, say, 3% of that and pay a probate fee on that.
Okay.
Yeah.
I've lost my hearing on my left ear a few years ago because of a preventive surgery, neurosurgery, of a tumor that was tangling up on the hearing nerve. And the fellow did whatever he could, and he couldn't save the hearing nerve, and I ended up being completely deaf on this left side. Now, is that How does it go with that one?
Not 100% clear, but I would say I would definitely. It affects you probably in that you turn your head to the right to hear people, and you might miss people coming up on your left-hand side, things like that. It changes the way you live daily because you cannot hear from that side. I would give you at least 75% of qualifying for the disability tax credit.
Thanks. Yeah.
And go to get a doctor to sign the form. There's a whole section. As I say, the form, doctors see this form constantly. They know it. Some of them charge a few bucks for it, which counts as a medical expense. But they know it, and there's a whole section on certain conditions. Hearing is one of them, blindness is another, things like that. Mental condition like Alzheimer's and lots of things like that is another. There is a whole section where either a general practitioner or an audiologist specialist can fill out that section saying that he feels it affects your day-to-day living and has done so since such and such a date. And if you send it off to Revenue Canada, it comes back, you've been approved from that date, and go back and redo those tax returns, adding it in there, and it can significantly get you back taxes that you back paid.
Thanks. I should pay attention.
Yeah, you should.
I would always, just one final thing, I'll give you, leave some stuff here for you. I would always recommend at some point in time you get your taxes done professionally, maybe just 1 year to make sure you're getting everything. Many people don't think about their whole situation. They come in and we ask them, are you taking care of anybody? And, oh yeah, 3-4 times a week I have to go over to my mother's place because, I cook for her and that sort of stuff. And well, you can claim a credit. They put them all together this year. There used to be several of them. Now they're all called the caregiver credit. If you're taking care of somebody who, you're helping out, it depends on how much you help out. Can't be just financially or something like that. If they're in a home and you handle their finances, they don't accept that. But these things can be transferred to you even though you're perfectly healthy, but you're helping somebody else out. Because they don't have enough income, they can. There are lots of other things. They brought even minor things like they brought in the Canada Employment Credit, which everybody gets a credit for some basic employment expenses, things like that, that people just never knew about, never learned about, and haven't been claiming it. But it's automatic. When I do it on a computer, it just bounces in there. I don't even have to. Once I put in employment income, it bounces there. I think it's worthwhile. Not with H&R Block, but to find somebody who will take a look at your whole tax situation at least once. Mentioned that German guy just this week. One of his former clients came in and we looked at tax returns, and he has, besides the German stuff, he does the Canadian, and on the Canadian he has never done pension splitting, and they're both seniors and have pensions that could have done pension splitting. Pension splitting has been around 10 years or so. Should have been done immediately, would have saved them a lot of money back immediately. Unfortunately, Revenue Canada only allows you to go back 3 years, so there's probably at least 7 years where they should have been pension splitting and saving a lot of money, which he didn't do, and there's no way of fixing it at this point. He just got, many people get in a rut, use last year's return as this year should be the basic same thing. I've got the same slips from the same investments, the same CPP, the same old age security, everything should be fine. And they put it in the same way and continue on and don't claim things which they should be. And so I would always recommend that at some point in time, have somebody take a look at it. Maybe it's only 1 year. It's worth your while. It's not, a huge expense. Again, if you don't go to Block. Our average tax return for a senior who has CPP, old age security, company pension, and some investments, maybe some charitable donations, comes in around 60, 65, 70 bucks a tax return. Now, to take a look at, again, closer to 200 at block. Just have if you want, just a one-time take a look. Am I up to date? Am I claiming everything? And if I don't come back next year, that's fine. You can do it, use it as a model for your next year's tax return. And a final thing about being a lawyer. You should have a will, and everything should be set up properly from a very early age. Once you have children, you see, I do these funny jokes, but you see in the materials, a newsletter I'm going to leave here. Once you pass away, too late. The government does have things set up. If you don't leave a will or instructions or what, or have the things set up the way you want after you pass away, the government will do it for you. And if you trust the government to do it for you, I have a bridge over Hamilton Harbor. I own it, and I'd like to sell it to you cheap. Because you must be pretty gullible. The government is not going to do it the way you want it. They're going to do it the way they want it. And there are limits on the things you can do, and they come in every day, You can't cut out your spouse, things like that you cannot do, and things you can. It's another thing where I think you need, once you have children and you want to take care of them after you pass away, and as I always say, you're the most careful driver. I was once hit by a drunk driver. I was driving perfectly well. I was not intoxicated. I was driving straight and in my lane, and he came across the road and hit straight head onto me and spun me around a few times, and I could have been killed. Just because you're not thinking you're going to die, doesn't take into account that other guy who's coming through a red light as you go through it on your own. So you got to be careful of that. Get things straightened out. Figure out ways. There are ways to save taxes, and there are ways to make sure that what you want is done after you pass away, and people are taken care of that you want to have them taken care of. It's not that huge an amount. It's one of those things where you generally should do it once. Buying a house, you spend a whole lot of money on a real estate agent, and a whole lot less money on making arrangements after you pass away. I can guarantee you that. Certain things in your life need to be done right. Deeds when you buy a house. When you go to university, you graduate from university, these are important documents in your life, and a will is an important document, and you shouldn't trust it to something you pick up in the bookstore, I don't think. Technically it works if you do it right, but if you do it wrong, too late. So if that's everything.
Thank you very much.
Thanks very much, Dan. Appreciate that. Good stuff. This is something you need to do. It is a bit complicated, and I can tell you it's worthwhile having some of your taxes, at least one, in pension, income splitting, and so on. It's worthwhile. At any rate, that's very good information, and hope you take it along and use it. Usually, most of the time we talk about things that are kind of philosophical and ethical and all that stuff in this organization, but we still live in a real world, and the real world has government in it. They have to pay for that Phoenix system somehow.
Taxes.
Yeah, Phoenix system, of course, is an oxymoron, but that's neither here nor there. Besides, we get lots of benefits from our taxes. I think when you think about it. I know we all say, "Oh, I hate paying taxes," but if you don't pay taxes, you don't have health care, you don't have roads, you don't have all that stuff. So, obviously a big debate, but it's important. There's no reason you should be paying more than your fair share. That's what the deal is. So, okay, so thanks very much. We can open the doors and that. When I do that, I give you a fair warning. The waitress will come back with bills.